There are a few IRS rules that stand between you and getting the most out of your tax situation. One that is not discussed very often is something called a wash sale penalty. Now, following wash sale rules is especially important to any investor that has a taxable account, whether that's some kind of joint account, an individual account, or a trust account. Now, we know by managing these accounts tax efficiently, we can gain an advantage with these accounts, but wash sale penalties stand between us and this tax alpha. And so in this video today, we're going to explain what wash sale rules are and a few tax hacks you can use in order to avoid wash sale penalties. Let's get into it. Now, if you're an investor with a taxable account, in order to get the most out of this account, you need to be doing something called tax loss harvesting. And here's conceptually how tax loss harvesting works. So let's say that we have an investor that is investing in this hypothetical fund A. Now, because of some market volatility, we happen to be at a point in time in the market where fund A is down 25%. Now, most investors will just simply sit on their hands when they're experiencing any kind of loss, but within a taxable account, we can use losses to our advantage. If we sell out of fund A, we essentially capture a loss. Now, if we don't have any other capital gains, we can take this loss and offset our ordinary income. Well, if we're in the 22% bracket, a $2,500 loss can offset our income, which translates to offsetting our tax bill by $550. Now, an investor doesn't want to lock in this loss, so they need to perform additional actions to gain any benefit from tax loss harvesting. Now, on the screen, you'll see an update of this situation, and there are a few boxes that I haven't filled in yet. We'll fill in some of those boxes as we move forward through this presentation. But let's say the same day this investor buys hypothetical fund ? Let's say this hypothetical fund mimics the performance of fund A. And so over the next year, let's say markets recover from this 25% decline and they recover back to break even. Well, then let's say this investor sells that fund because they need retirement income. And so they essentially captured a long-term gain then of $2,500 at 15% based on the brackets they were in. They would owe in tax of $375. And so they offset income at a higher rate, and now they're recapturing that income at a lower rate. So they had a tax gain of $175 on a $10,000 investment. This translates to a 1.75% after-tax return. Now, their investment didn't grow through any of this time period here, but yet they gained a tax benefit from this. Now, if this investor didn't need that money for income, they could continue to defer those taxes, and now they're earning an ROI on the taxes that they saved, that $550. As we move through time, as that compounds, this after-tax return will have grown. So there are numerous studies on tax loss harvesting that find that tax loss harvesting to the average investor is worth anywhere from 0.5% to all the way to a percent extra after-tax return on an ongoing basis. And so this is also where the idea of a wash sale penalty comes in. You see, the IRS understands its rules. It understands that investors can take a loss, offset income at a higher rate, and recapture that later at a lower rate. And so to prevent investors from simply selling out of a given stock and taking a tax loss and immediately buying back into that same stock, there's something called a wash sale rule. For instance, if this investor sells out of fund A and immediately buys fund A back again, they will break this wash sale rule. Now on the screen, I have a dictionary definition of what a wash sale is. This is taken from the SEC website. And so this doesn't offer a ton in the way of understanding what a wash sale is. If you're more confused after reading this definition than you were before reading this definition, you're in luck, because we're going to fully explain exactly what these substantially identical securities mean and what all qualifies as a wash sale. But first, I want to touch on what happens when you break that wash sale rule. So if you take that $2,500 loss and you immediately buy back into fund A, essentially what happens is that loss is completely canceled out. Now, luckily, your cost basis isn't reset. And so understand that the risk in that given year is really the performance risk from when you sold and when you bought. And also the risk is that you obviously don't get to take that given loss, which is the whole reason you performed any of that given activity. Now, the first thing that's important to understand about wash sales is the time restrictions around this. 30 days before rule essentially says that you cannot capture a loss within 30 days of buying into any given investment. So let's say that we bought into Google and Google had earnings and immediately dropped by 15% the following day. Well, we cannot sell out of Google that following day, capture a 15% loss, and gain a capital loss that we can offset with. Now, there is also a 30 days after rule that specifies that once you sell a given investment, you cannot buy a substantially similar investment within 30 days after selling that investment. If you do, that capital loss will be completely reversed. And so we need to keep in mind both of these 30-day rules. Furthermore, it's very important to understand that you can have a wash sale violation indirectly. So it doesn't necessarily have to be a direct violation. What do I mean here? Well, there are 4 indirect wash sale violations that you need to understand. The first is if you take and purchase that given investment in a different account. So let's say that we sell out of Apple at a loss within our taxable account, and we know we don't want to buy back into Apple in that same account, and so instead, we buy back into Apple in our IRA. Well, unfortunately, this is not allowed. This would be breaking a wash sale rule. Next, if you purchase a derivative, whether that's an option or some kind of other derivative like a warrant, that will also be a violation. If you sell a given investment and then purchase a dual class share, this is once again a wash sale violation. So for instance, if we sell out of Berkshire Hathaway Class A and we take a capital loss and buy back into Berkshire Hathaway B, that would be disallowed. If we also purchase a company that is merging with the company we just took a capital loss on, once again, this would be a violation. So let's say we sell company ABC, we buy company XYZ, and they are merging together. This is not allowed. And so you see that we start to really build into quite a bit of complexity here, but we haven't yet gotten to the most confusing part of wash sales. Within the IRS documents, you will see a term often referred to as substantially identical or substantially similar securities when in reference to wash sales. What exactly does this mean? Well, on the screen, I have the IRS's definition from publication 550 that talks about substantially identical securities. And what you'll see is they reference a lot of individual securities and talk about derivatives of that security. But there is a ton of gray area here that the IRS hasn't commented on. But what about this situation on the screen right here? These are both funds, ETFs to be specific, and we're using Vanguard's S&P 500 ETF, VOO, and Spider's S&P 500 ETF, SPY. Could you sell out of VOO and take a capital loss and then immediately buy back into SPY? We know moving forward, these will be almost identical in terms of performance. But there are some questions that lead us to believe they might be substantially different in the eyes of the IRS. Yes, these do both try to track the S&P 500's performance, but they are from different companies. Vanguard versus State Street Global, Spiders. Is that different enough? They also have a different expense ratio, so we'd expect a higher expense ratioed fund to have a little bit more of a performance drag over time. Does that lead to substantially different securities? And the IRS hasn't and won't comment on this. I'm guessing at some point in the future they'll be forced to weigh in on this given conversation, but they haven't yet, and this leads to a ton of gray area. So how can you build in extra levels of confidence to be able to tax loss harvest properly moving forward into the future? Well, luckily, I'm going to give you a few tax hacks, and really it all comes down to what I would call vectors of difference. The further that we are able to stack these vectors of difference, the better case we'll be able to make to the IRS if they ever do rule on this gray area. And so on the screen, I have 4 vectors of difference that are ranked from the most different to the least different. So the first one is funds that hold a different basket of investments. And this is the most important one and will allow you to sidestep any wash sale rules almost regardless of what the IRS rules on. So for instance, let's say that we sell out of something like the S&P 500 that holds the 500 largest companies, and we buy into an ETF that holds the largest 750 companies. Well, this would hold a different basket of investments and would be a substantial enough vector of difference. So let's say that we have 2 large cap value ETFs, but they track different indexes. The underlying index, one bases on price to book ratio, the other bases on price to sale. Both of those are value metrics, and they might hold a lot of the same investments, but those underlying indexes are different enough and have a different methodology for what those given indexes hold. Number 3 would be different fund providers. So if we go from Vanguard to State Street Global to Schwab to iShares, this once again offers another vector of difference. And then finally, using a different investment vehicle. So if before we were holding something like a mutual fund, and now we're going to hold something like an ETF, once again, that is a vector of difference, but I would argue is significantly less substantial. And so again, our goal here is to stack those differences. I'll give a few examples here in just one second, but it's very important to also understand that the IRS does not look at correlations. It'd be almost impossible to rank substantially similar securities based on correlations. For instance, let's say that we have Ford and GM stock, and for whatever reason they are highly correlated over the last couple years. Well, would the IRS consider these substantially similar securities? It'd be almost impossible for them to consider that because these are vastly different companies, but yet they're very highly correlated. And so we can apply this same principle to ETFs, to fund investing, because a lot of these will be highly correlated, which is fantastic from a performance standpoint. But the IRS does not look at these correlations. This is extremely important to understand. So let's go through an example of stacking some of these differences. We're going to look at an investor that is currently invested in Vanguard's Total Stock Market Index, VTI, and they're going to sell out of this investment to take a capital loss. So what can they invest back in that is substantially different enough? Well, right now, Vanguard's S&P 500 ETF would be considered substantially different enough. We're stacking on two vectors here because we're stacking on a different basket of goods, and we're also stacking on tracking a different index here. We're still using Vanguard, and we're still using the same vehicle with an ETF, but we have two vectors of difference here. Now, as you can see, looking at the performance, these are quite correlated and have performed very similarly, matching ebbs and flows through time. So this would be an awesome candidate for that tax loss harvesting idea. So now we're looking at IVW versus SCHG. Both of these are US large cap growth oriented ETFs that will probably hold a lot of the same securities, but they are different in the way that they track different indexes, and they also are from different fund companies, iShares versus Schwab. You can see that IVW tracks the S&P 500 Growth Index, and SCHG tracks the Dow Jones US Large Cap Growth Total Stock Market Index. So these are two different indexes, and they are obviously from two different fund companies. But as you can see, they perform almost identically. But once again, they are different enough and should be in the eyes of the IRS that they would not be considered substantially similar. Now, this being said, gaining the most out of your taxable account isn't just about tax loss harvesting. In fact, it starts at the foundation. And in this recording right here, I have 5 taxable account rules that you need to follow for tax efficient investing. Now, the good news is these are much simpler than these wash sale rules we covered in this video today. Thanks for watching, and always remember, you don't need more money, you need a better plan.